Welcome back. The price of crude oil has been volatile recently. It dropped to less than 75 US dollars per barrel earlier this week before jumping today on news of the killing of a senior Hamas leader in Iran. Our next guest believes market fundamentals point to a price of West Texas Intermediate crude of about $80 US per barrel. And he's bullish on the shares of Canadian producers, even after they have outpaced the broader market so far this year. Joining us now is Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners. Eric, thanks a lot for coming in.
You bet. Good to be here.
Why don't we start with the news today that's giving oil a boost? How do you factor into your thinking, if at all, events like the event in Iran, which is dialing up geopolitical tensions in that part of the world?
It's very difficult for energy investors because you have fundamentals and you have a lack thereof or some element of geopolitical risk premium. We really have to give a shout out to Lima Croft at RBC, who's been calling about the potential for greater escalations regionally. Last night, this morning, major escalation increases the chances of it becoming more of a regional battle and finally involving actual supply. I think this has been a market that has been ignoring this risk. I still think it's a market that needs to see actual interruption in supplies. And my advice to energy investors is your investment thesis should be predicated upon fundamentals, supply, demand, inventories. Geopolitical risk premium or lack thereof shouldn't really be a factor. But for those who've been calling this out, we should give them kudos.
Okay, let's talk about the fundamentals then. We see oil now at about 77 US dollars per barrel today. There it is right there, essentially 77. You think this is, 80 is your number for the rest of this year, is that correct?
It is, in 2025. So we're recovering from a deeply oversold level that I think has been really CTA selling. Commodity trading advisory accounts. So they're algorithmic, is technically based. And what we saw was the CloudStrike event of Friday of a week or so ago led to a liquidity vacuum. Oil sold off $3 and absolutely, there were no headlines to explain that. I think that triggered technical selling in a summer market where a lot of traders in London are hitting the beach at the time. So oil is sold off. We're now slightly recovering from that. We're going to have a big DOE draw this morning, indications that despite fears of weak demand in the United States with McDonald's and Starbucks, missing expectations, we know China's weak. Demand globally still is fine. It's not ripping, but it's fine. The real story is global oil inventories right now are at a record deficit relative to average levels. We have OPEC Plus compliance having vastly improved. We see exports in June, July, and now August meaningfully down. And we see inventories drawing to record low levels, even with this fear of weak demand globally, with reminders of Starbucks. And just evidence here and there that the consumer is cracking a little at the fringes. So that's the real story. When we look at where inventories are today and where they are going, even with the full return of curtailed volumes by OPEC Plus, we see a fundamental case for about $80 WTI. And there's a big if to that. Given oil volatility, given the U.S. election, given geopolitical events, my base case is that we will not see the return of OPEC Plus volumes beginning in October. I think OPEC Plus there's the idiom of being proactive, preemptive, and precautionary. I think there's just too much volatility, too much uncertainty about the health of the global consumer that we'll see a deferral of the return of those barrels. Okay,
the stocks, the Canadian stocks, as measured by the S&P TSX Energy Index, or there's an ETF, XEG, up 18% on a total return basis this year. That's 8% more than the S&P TSX composite. Your fund, the Ninepoint Energy Fund, NNRG, has essentially doubled the return of the S&P TSX composite so far this year. And you think there's more to come in the shares of Canadian oil and gas producers?
I do, and thank you for pointing that out. So energy investors still feel, I find, depressed. And yet we're winning. We're almost in fact, we're almost doubling the NASDAQ, energy versus tech. We're more than doubling the TSX, but there's this moroseness to energy investors. I just don't get it. We're winning. This is the place to be.
Is it because they want to see the commodity go to $100?
Honestly, I don't know. The stocks have done well. We don't want to double overnight. We want to gradually grind out returns. 20% a year per year is not terrible. So energy stocks still represent unbelievably compelling value. When you look at $80 oil, where we think gas will be next year around $3.75, the sector's trading at a 14% free cash flow yield. Balance sheets, final debt targets being hit. We expect names, some of the oil sand names, to be hitting it any day, any week. And it's this meaningful return of capital where if you're a 14% free cash flow yield, You either have no debt or little to no debt. So you're giving all of that free cash flow back to investors in the form of buybacks. It doesn't take many quarters of such meaningful share buybacks to drive a further re-rating. So I look at some Canadian names trading.
A re-rating is a multiple expansion.
Correct.
Right.
Yeah. So we've gone from, let's say, the large caps 4 times to 6 times. Well, the U.S. guys who have an inventory challenge, they don't have nearly as much drilling and stay flat inventory as Canadian guys. They don't have the benefit of 39% foreign exchange premium with the loonie being in the crapper right now. So there's all these reasons to be in Canada versus U.S., yet our names trade at a discount. And the final reason, we have a political risk discount, and we expect that to be eliminated fall of next year. And so it's the ability to buy these businesses with 20, 30, 40, 50 years of inventory, trading at 12, 14, 15, in some cases 28% free cash flow yields at the current oil price and a slightly higher natural gas price. So we still see a lot of meaningful upside from here. $80 oil for names to approach fair value, we still see about 70 to 75% upside in general.
Okay, there's 3 sectors of the Canadian sector, subsectors of the Canadian sector that you like. Canadian oil sands, Canadian natural gas, and Canadian oil field services. Why don't you take some time and just go through that list and why you like them?
Yeah, so I meant fairly broad, but Canadian oil sands, again, you get decades worth of free cash flow with companies with their best balance sheets in history returning all or almost all of that free cash flow back. And it's this general apathy towards energy stocks. We don't need people listening to me now. We don't need the institutions to have an interest to get these stocks to continue to perform very well so long as companies buy back stocks. And that's the religion. So really it's, you've got the largest company trading at a 12% free cash flow yield, the smaller guys 14-ish%. We're adding, in literally real time, hence why I'm not mentioning the names, to liquids-rich natural gas names now. We have LNG Canada coming on at the end of this year. It's going to suck up 10% of Canadian domestic supply. We have increased LNG in the Gulf of Mexico. Canadian producers benefit from that. Plus, at $80 oil, those that are producing condensate, it's kind of like oil, are generating gobs of free cash flow. So I'm actively buying names now with 20 to 30 years of stay flat inventory, trading at 14% free cash flow yields and 3 times their cash flow. That's ridiculous. The last thing is service names. Select basis. We're a large shareholder in one. They just reported last night where they're trading at a base case now with Canada doing well, U.S. not so much. We have them at about a 21% free cash flow yield this year, getting optionality to a better drilling market next year as there's a demand to grow natural gas supplies in the United States. We have been trading at a 24 to 25% free cash flow yield 1 year out. This is a company where their equipment lasts 20 years, but they could privatize in 4 out of free cash flow. So there's an abundance of opportunities. Energy investors should be a little more joyful because we're winning. We're beating everybody else in other sectors. And we see meaningful upside ahead at the current oil price. We don't need a higher oil price.
We'll have to leave